what defines a trading market, and what advantages may come from the existence of multiple trading markets. Hi, I am Mahmoud Alkudsi, ADSS Senior Market Strategist. In part 1 of this two-part financial market video, we discussed foreign exchange and commodities market. You can find first part of the video at the top of the screen. In part 2, we'll be looking at more global markets, taking a closer look at the stock market and the bond market. The stock market involves trading on shares from publicly traded companies listed in the stock exchange. Companies wanting to list their shares must meet specific criteria related to capitalization and market presence. When you buy company shares, you acquire small ownership stake to earn profit. This can be realized through quarterly dividends or by capitalizing on fluctuation in share prices. There are 3 primary categories of companies. The first, large companies. These have significant capitalization, typically paying quarterly dividends and offering stable growth in share value. Second, medium companies. With an average capitalization size, they carry slightly higher risk but may offer greater growth potential. Some may pay quarterly dividends. The third, small companies. These companies usually have smaller capitalization size and may not pay quarterly dividends. However, they could experience substantial growth in share value if they become successful. What factors affect stock prices? The biggest factor affecting stock prices is the company's profitability. Higher profitability drives up demand for shares, leading to price increases, while the opposite is also true. Investors track companies' performance through quarterly reports, which provide insights into its profits each quarter. The bond market allows governments and companies to borrow directly from investors by issuing and selling bonds with a specific value, duration, and interest rate. So, if you purchased $100 government bond for 1 year with 5% interest rate, you would receive the $100 plus $5 in interest at the end of the year. Bonds are classified by the issuing entity, sovereign or corporates, and duration, short-term, mid-term, and long-term. The interest rate of a government bond correlates with its duration, meaning that longer-term bonds generally offer higher interest rates. If a short-term bond interest rate exceeds those longer-term bonds, it may signal market concern about an impending economic recession. Bond interest rates are also influenced by borrower solvency, with higher risk associated with higher interest rates. What factors affect bond prices? There are many factors associated with the economic stability of the issuing country that can influence bond prices. It is important to emphasize the inverse relationship between bond prices and bond interest rates. When bond prices decrease, bond yields rise, and vice versa. In conclusion, diversified trading markets let investors to diversify and mitigate risks within their financial portfolios. When stock markets experience declines, bond prices may increase, potentially offsetting losses suffered in one market with gains from the other. Traders can trade on stocks and bonds with ADSS through CFDs. For more info about contract for differences, please check the video on top of the screen. Well, that's all for this video. Don't forget to watch part 1 if you haven't already. Thank you for watching, and I'll see you in the next video, where we will continue to learn about different aspects of trading.